We have Cern Basher back again. Cern is probably going to be pretty regular. We're thinking of having him on each week, maybe around Thursday, if it works out that way. And Cern is a financial advisor. And would you take on another client if they were, interested, Cern?
One or two.
Okay.
Sure.
So they should call Brilliant Advice, right?
They can find us online at brilliantadvice.net.
.net. Make sure that you put the .net. If you want to find this, you have to be smart enough to remember that .net part. Okay, brilliantadvisor.net. All right, Cern, today we're going to be as brilliant, or you're going to be as brilliant as you possibly be and take me along for the ride. We want to talk about some aspects of things like free cash flow and whatnot. I know that might sound like, what? That's so in the weeds, but this is free cash flow is one way to value a company, but we'll talk about a couple of different ways, I think, to value companies. And then we'll talk about some examples in the past, like Apple and Amazon, and how that might help you understand Tesla today. Is that about what you're going to do? Did I get it kind of right?
Well, yes, I think actually we're going to do a couple of different shows on this. And so there'll be elements of both in each one. So
Okay.
folks might want to make sure they check out both of those. But today I'd like to discuss some examples of some other companies and how that relates to sort of the challenges that Tesla is going through today.
Okay, good.
So let's talk about Apple. Not the fruit, the company. So a lot of investors focus on the PE ratio. And this is a chart that's showing Apple's PE ratio for the last, I think, 20 some years. And it's kind of interesting, but also not really, because, at some point, one point, Apple was trading 85 times earnings. And this is looking at the next 12 months. So at the time that this was 85, this is looking at earnings over the next 12 months. And so it's a forward-looking measure. You can look at PE ratios that look at the last 12 months.
Right.
But that's like driving a car looking in the rearview mirror. You should always look forward when you're investing. And you can see that Apple's PE ratio fluctuated a lot. And at one point in 2013, reached a PE of only 10.
Right.
And so the market was more or less telling, investors were more or less telling the market that Apple had stopped growing, basically, that it wasn't a very attractive company. Now, 2013, I mean, we're still in the iPhone boom.
Yeah.
Right. And in recent years, the PE has moved up into the 20s to 30s. Okay.
And that's been primarily on the back of SaaS. Or I guess really not SaaS as much as software being sold through their
App Store.
App Store and whatnot. Yes.
Sure. So this is looking at Apple from 1983 onwards. The bottom chart is called drawdown. And you can think of drawdown as kind of the iceberg under the water. How far down does the stock price go from its all-time high before it recovers an all-time high? So every time this line is reaching this level, the stock's hitting a new all-time high.
I see.
Now, you can't really see it here because it's so flat in the past, but you can sort of see it here. Every time the stock's reaching this line, it's hitting a new high. But in terms of investment risk, drawdown sort of shows the severity of the ride as we go. Like no one complains when stocks hit a new high, right? The volatility we care about is the downside volatility.
Yeah.
Right. And so that's drawdown. Now, it wasn't uncommon for Apple back in the 80s and 90s to have 80, 70, 80% drawdown. Now, this is Apple Computer Company.
Right.
And with the introduction of the iPhone, it became a very different company. Right. But still, we had drawdowns of 60%, drawdowns of 40%, 30, 40, 30, 30. Right. And right now, Apple is down 14% from its all-time high.
Right.
Okay. So Apple wasn't immune to fluctuation in the market. as well, right?
Sure.
Now, the saying is that stock prices follow earnings. And I would say that generally that is pretty true. And this is a chart that overlays the stock price of Apple, which is in blue, and the earnings expectations of Apple, again, next 12 months, earnings in red. And so you can see there are times here, for example, when the earnings expectations went down for a year or two, and the stock also went down. Same thing here. So as great as Apple has been, it wasn't a smooth ride up. There were times when earnings expectations went lower for a year or two.
Sure.
And then it recovered, earnings expectations rose, the stock rose to new highs, another bump along the way, another bump along the way. So there were many bumps in Apple's growth story. Okay. And the bumps in the earnings were smaller compared to the bumps in the stock price. For some reason, stock price bumps tend to be magnified versus the changes in the earnings expectations.
Yeah.
And we'll talk about that a little bit more in a minute. Okay. At the end of the day, and this is where our other video will be helpful to a lot of folks, free cash flow is really all that matters. Free cash flow is simply how much cash does the company make, not earnings, but cash, there's a difference, over and above its CapEx, capital expenditures. So free cash flow, how much money could they they don't need it for the business anymore. This is extra money that they could do whatever they wanted to. They could pay a dividend, they could buy back stock, they could make acquisitions, they could just keep it. So in Apple's case, this company has gone from making $5 billion or so on a rolling 12-month basis. Okay, so LTM last 12 months.
Okay.
To now, in the most recent quarter, $106 billion of free cash flow. So is it any wonder that Apple is one of the most highly valued companies in the world?
Yeah.
Right? Now, again, there's lumps in this. This is not a smooth chart up and to the right. There are periods in Apple's business where they have done well and they've struggled. Done well, struggled. Found a new high, struggled a bit. So for any great company, this is perfectly normal that there's bumps in the road. It's not smooth sailing all the time.
Sure.
Okay. Microsoft, very similar story. Very high PE coming out of the internet bubble. Okay. 60, 70, 80 times earnings. And then down in the depths, 2010, 2013, PE of around 10. And then a recovery in recent years, and now PE of about 33. Okay. Was this a good time to buy the stock? Right? Was this a good time to buy the stock? Well, it turns out that was, but it turns out also that this happens to be a pretty good time to buy the stock. So the PE multiple really isn't a very useful metric at all. And I think people tend to focus on it too much. Now, the interesting thing about Microsoft is coming out of the internet bust, its stock dropped over 60%. And in fact, the drop in 2001 wasn't as bad as the ultimate drop by 2009. And I'm sorry that this part keeps coming up here, but stock dropped essentially about 70% from its peak. It took 14 years for Microsoft to hit a new high. Okay.
So there's hope for Cathie Wood.
There's hope for Cathie Wood. There's hope for, yeah, right. A lot of people tend to forget this, or I mean, this was a painful time for many Microsoft investors.
Right.
And if you look at the next chart, their earnings over that time period were generally going up. Right. And yet the stock was languishing year after year after year, 14 times.
Yeah.
Okay. And you can see here the blue line kind of flatlined, and the earnings were catching up to the stock price,
Right.
powering ahead. And eventually investors woke up to that and the stock started to move up and follow earnings
Uh-huh.
higher.
Yeah, interesting.
Okay. Free cash flow. Now, I guess you could say in those years when the stock didn't do so well, free cash flow was kind of languishing, and maybe that was an issue. But certainly, over the long term, the progress of growing the free cash flow. And Microsoft now in the last 12 months has generated 67 billion in free cash flow. Pretty healthy number.
Very healthy number.
Okay. But not that long ago, it was a lot lower.
Right.
Okay. All right, Amazon. Amazon had a massive PE, 400 times earnings here in 2015. In fact, there were a PE couldn't be calculated because there was no earnings. And now it trades at about 41 times. This is a company I think that a lot of Tesla investors look to in the past and say, well, yeah, it traded at a high PE multiple, so Tesla can too. Right. And certainly that may be the case. And Amazon actually may be a really good instructive example for Tesla investors for many reasons. Amazon also suffered a big drawdown coming out of the dot-com bust. It took many, many years for Amazon to hit a new high.
Mm-hmm.
And then most recently, another 50%, almost 60% drawdown not too long ago.
Mm-hmm.
And now finally, Amazon is within 5% of its all-time high. Okay. Earnings and stock prices tend to follow each other. So what was the problem over the last year or two? Well, earnings expectations went down.
Yeah.
Okay. They enjoyed a nice bump from the pandemic. Like a lot of companies, they suffered and now have made a remarkable recovery in both earnings and stock price. Okay.
Mm-hmm.
Now, if you were an Amazon investor and down here, you said, well, earnings are going to go down for the next year. Let's get out. All right, let's wait for a better price.
Mm-hmm.
Well, you might have been able to time that, or maybe not. Because how did you know that this was the bottom of the earnings expectations?
Mm-hmm. Mm-hmm.
Right? It just turns over time. And yet the stock price, can move up very quickly. So this is the challenge, I think, of many investors is that they want to try to time it. And it tends to make the stock more volatile than the actual earnings themselves.
Sure.
Of all the activity around trying to time it.
Mm-hmm. Mm-hmm.
Amazon's free cash flow. So this actually is kind of interesting because they had very little free cash flow for many, many years, building the business and putting every dollar back into making it bigger and bigger and bigger. Didn't have a whole lot of free cash. Eventually, they get to the point where they're making pretty good free cash flow on the strength of their AWS business.
Mm-hmm.
And then they hit an air pocket. Okay. And so we saw on the previous screen how much Amazon stock price went down.
Right.
But how much did the company really change? How bad really was it? Well, turns out a couple of years later, everything looks great.
Right.
And now that their free cash flow is higher than it's ever been.
Mm-hmm.
So a lot of investors tend to get caught up in the short term and sort of forget, these companies are building and investing for the long term.
Mm-hmm.
And as bad as it may look in the short term, things can change really quickly. Right. And it has.
I'm having a hard time remembering why Amazon was so beat down over that period.
Yeah, I don't have the specifics in my mind either.
Yeah. It's funny. I just can't remember.
Yeah.
Usually I'd have it right on the tip of my tongue, but I can't really remember.
Yeah, Amazon is a company that I follow not as closely as some other companies, but certainly an attractive long-term opportunity. Okay. Meta, Facebook. Here's the PE over time, up and down like all these other companies, currently trading at 25 times forward earnings. Here's the drawdowns. Similar recent problem, although here the drawdown's even bigger, over 75%.
Well, we know about that one.
Yep. Right. Investing billions of dollars into the metaverse, everybody questioning Mark Zuckerberg's sanity.
Right.
And now it's an AI company.
Right.
So it's interesting how things can change.
Uh-huh.
Stock price follows earnings expectations, for better or for worse. And here's their free cash flow. Took a dip, recovered, all-time high.
Right.
Okay. Here's Nvidia. Now, the Nvidia story is one of many peaks and valleys with new product cycles and getting it right and then not getting it right. And boy, now did they get it right.
Yeah.
But look at the ride in Nvidia. Look at the drawdown. 80, 90% drops in the stock price, right? Multiple times. And in recent years, 50 to 60% drops in the stock price. And this last one was not that long ago. Okay. And here is the stock price versus their earnings. And here is free cash flow.
Wow.
We haven't seen anything like this before. Now, it remains to be seen how sustainable this is.
Sure.
Right? And that's the big question for Nvidia. But what a remarkable growth story it has been.
Yeah. Yeah.
Okay. Okay. Bring it back to Tesla. Tesla is like all these other companies, but it's earlier in its growth phase than all the companies that we just talked about. Now, its PE multiple has been super high, and it's also been fairly low. A year ago, it was under 20. Currently, it's trading at 56 times next 12-month earnings. Again, I don't think that's very instructive. And currently, the stock price is down 56% from its all-time high, seen in 2022,
Right.
or the 21. All right. Stock price follows earnings expectations with some added volatility thrown in for good measure.
Yeah.
Right. And then free cash flow. Tesla is a very different company than Amazon, Microsoft, Nvidia. They're making automobiles. It's a very capital intensive business.
Right.
Right. So, for years, they didn't have any free cash flow. Their CapEx ate up all their earnings and then some. Only in recent years have they had free cash flow. And then in recent quarters, it's come down a little bit, but still free cash flow positive. And for the growth that this company is achieving, it's actually pretty impressive that they're free cash flow positive.
Right.
Now, it's possible that in the next quarter or two or three or four, maybe they won't be. But what are they putting their money to? Right? Where is that money going? Are they investing it in the business for future growth?
Yeah.
Right? Are they squandering it on acquisitions? No.
No.
Right? Are they returning it to shareholders? No. Not yet. Right? There'll be a time for that. So my sense is that people are so fixated on the short-term problems, they're losing sight of the longer-term opportunity. Okay. In our next video, we're going to talk a little bit about how to value companies at different stages of their life cycle. And I think the valuation approach for Tesla should be very different than for Apple or Microsoft or some other companies.
Different stage of life.
Yep.
You would not invest very much. You might invest a lot of money in Cern Basher right now because you have so many more years to build that building by the side of the freeway with the blue windows. But you wouldn't want to necessarily take a long-term shot on Randy Kirk, who turns 76 next week.
I think you might be a good bet as well.
I may have built all the buildings I'm going to build at this point.
I doubt that.
Okay, Cern. Well, all right. This is super interesting, and love your slides. Love all the work you put into this, and it should be giving people some confidence in you as a financial advisor. I would think. I don't know. Maybe.
Yeah, it's certainly not as simple as just looking at the PE ratio and the stock price. And the next video that we're going to do, so this is really, we should consider this part A of a two-part video,
Okay.
is looking at really what matters and different ways of approaching valuing companies.
Now, I hadn't spent much time in my 50 some plus years of playing the stock market and truly understanding how PE ratios get established. But Gary Black has done a lot of that work on X. And I'm not sure whether you agree with Gary Black or not, but he tends to, and I'm sure he didn't make it up, he's probably using somebody else's approach. He tends to use a theory that has a multiple of the expected growth in income over the next years. So that if you're growing at 50%, your PE ratio might be around 50 to 60, somewhere around there. But if you're only growing at 20% or expected to grow at 20%, your PE might be around 20% or 20. Is that anywhere close to how you would look at PE ratios?
No, it's
No.
it's pure voodoo.
Okay.
It's a shortcut. It's a lazy shortcut.
Okay.
Again, not to put Gary down.
Yeah,
Gary's
yeah.
great. He's a smart guy, but using PE ratios is a terrible way of valuing companies.
Okay. All right. I was curious about that because I just, that's, again, I haven't really spent a lot of time trying to understand it other than that learning that I did with Gary. Okay. All right. Cern, super job. Look forward to part 2 or part B of this particular one. And we've got a couple of other videos with you over these days. So people should be looking back or looking forward. See, this one is going to be the first in the series. It will be up on Thursday. So people can look forward to maybe one a day for the next few days.
Wow, that's scary.
Stuff from you. Well, you've just been busy. You've been busy, sir. All right. And so thanks again. And to all of you out there, it has been great talking to you.